Tonight, silver stands at $99 an ounce, just $1 away from a psychological threshold that hasn't been tested in decades, $1 from a number that exists more powerfully in human psychology than in any mathematical model. This is not about celebrating or panicking. This is about understanding what happens when markets reach points of genuine significance. If you hold silver, if you're considering entering the market, or if you simply want to understand what forces are moving through the financial system right now, the next 25 minutes will matter. Because round numbers change behavior. They change how investors think, how institutions position themselves, and how narratives spread through markets. A break above $100 per ounce would represent more than price movement. It would represent a shift in collective perception. And perception, as we know, drives markets as powerfully as fundamentals. We're going to walk through this moment with clarity and discipline. We'll examine what brought us here, what a breakthrough might mean, and most importantly, how to think clearly when everyone around you might be losing their heads. This is not financial advice. This is financial education, a framework for thinking when the noise gets loud and the emotions run high. Let's begin. Silver at $99 represents something rare in financial markets, a convergence of technical levels, psychological thresholds, and fundamental forces all arriving at the same point simultaneously. Understanding this moment requires us to step back from the price itself and look at the architecture beneath it. First, consider what $100 means psychologically. Humans are pattern-seeking creatures who assign significance to round numbers. 10, 50, 100? These aren't just prices. They're mental anchors that shape how millions of people perceive value. When gold crossed $1,000 in 2008, the media attention multiplied overnight. The same pattern repeated at $2,000. Round numbers create headlines. Headlines create awareness. Awareness brings new participants. This isn't irrational. It's how information spreads through complex systems. Price breakthroughs become signals that cut through the noise of daily market movement. Silver approaching $100 carries additional weight because of its historical context. In 1980, during the Hunt brothers' attempt to corner the market, silver briefly touched $50. Adjusted for inflation, that would be approximately $170 today. We're nowhere near those inflation-adjusted highs, but we're approaching nominal levels that will trigger memories, comparisons, and renewed attention from investors who haven't thought about precious metals in years. Second, consider the technical picture. Markets move in waves of supply and demand. When prices approach significant levels, these waves intensify. Buyers who've been waiting for confirmation see round number breaks as entry signals. Sellers who've been holding for specific targets see them as exit points. The concentration of orders around psychological levels creates what traders call support and resistance. These aren't mystical concepts. They're simply the aggregation of human decisions clustering around numbers that feel significant. Third, and perhaps most importantly, consider the fundamental backdrop. Silver doesn't move to $99 in a vacuum. It moves there because of shifts in real-world supply and demand, monetary conditions, currency movements, and industrial consumption. The current environment combines several powerful forces. Central banks globally hold massive balance sheets. Government debt levels remain historically elevated. Industrial demand for silver and solar panels, electronics, and emerging technologies continues growing. Meanwhile, primary silver mine production faces constraints. These aren't overnight developments. They're structural conditions that have been building for years. Price is simply the mechanism through which these forces express themselves. What happens if silver breaks through $100 isn't predetermined, but we can examine the dynamics that typically unfold around significant price levels. History shows us patterns, not guarantees, but recurring behaviors that help us think probabilistically about what might come next. When assets break through major psychological levels, several things often occur in sequence. First comes confirmation. The initial break might be brief, a spike that quickly retreats. Markets test resolve. Is there genuine demand above this level, or just speculative excitement? If the break sustains, attention follows. Financial media, which operates on novelty and significance, amplifies the story. Silver breaks $100 becomes a headline that reaches far beyond the precious metals community. This attention phase is critical. It brings in what market observers call late-stage participants. These are investors who weren't following silver at $70 or $80, but who respond to breakthrough headlines. Their participation can create momentum. More buyers create higher prices. Higher prices create more headlines. More headlines bring more buyers. This is the feedback loop that drives major market moves. But feedback loops work in both directions, and this is where discipline becomes essential. Because the same dynamics that push prices higher on breakthrough can reverse with stunning speed. And when momentum slows, when the last headline-driven buyers have entered, the absence of new demand can trigger rapid declines. Round numbers that act as magnets on the way up often become ceiling points on the way down. The $100 level could become a reference point that traders watch for months or years afterward. None of this is certain. Markets are probability distributions, not predetermined scripts. But understanding these dynamics helps us prepare for multiple outcomes rather than anchoring on a single scenario. The intelligent investor doesn't ask, will silver keep rising after 100? The intelligent investor asks, how do I position myself to benefit if it does, while protecting myself if it doesn't? To understand where silver might be headed, we need to understand where it's been, not just recent price history, but the longer cycles that shape precious metals markets. Silver has experienced several major bull markets in modern history. The 1970s saw silver rise from roughly $2 in 1970 to $50 in 1980. That's a 25-fold increase driven by inflation fears, currency instability, and speculative excess. The peak, as we mentioned, ended badly. The Hunt Brothers market manipulation collapsed, prices crashed, and silver entered a 2-decade bear market. By 2001, silver traded below $5. Then came another cycle. From 2001 to 2011, silver climbed from under $5 to nearly $50 again. This bull market was driven by different forces: quantitative easing, sovereign debt concerns, and broad commodity inflation. The peak in 2011 was followed by another bear market. Silver declined to below $14 by 2019. It languished for nearly a decade while stock markets soared. What do these cycles teach us? Several critical lessons. First, bull markets in silver can be explosive and sustained. Multi-year advances that multiply prices several times aren't anomalies. They're features of how thin, volatile markets respond to fundamental shifts. Second, peaks tend to be sharp and followed by long corrections. Silver is not an asset that trends gently upward over time like diversified equity portfolios. It moves in violent swings, with long periods of decline or stagnation between explosive advances. Third, the drivers of silver bull markets tend to be macroeconomic, currency concerns, inflation, monetary expansion, geopolitical instability. These are the forces that push investors toward tangible assets. Where are we in the current cycle? That's the critical question. Silver bottomed in the high teens during 2020. It spiked during the initial pandemic uncertainty, then consolidated for several years. The recent move toward $100 represents a sustained advance that's been building momentum. Is this the beginning of a new major bull market comparable to the 70s or 2000s? Or is this a shorter-term move that will exhaust itself and reverse? Nobody knows with certainty. Anyone who claims otherwise is selling you something. What we can do is examine the conditions that historically support sustained precious metals bull markets and assess whether they're present today. Sustained bull markets typically require currency instability or debasement, inflation or inflation expectations, geopolitical uncertainty, broad commodity strength, negative or low real interest rates, and institutional or retail participation. Many of these conditions exist today. Central banks continue expanding money supplies despite recent tightening. Geopolitical tensions remain elevated. Government debt continues growing. Real interest rates, while positive now, remain historically contained. The setup is constructive for precious metals. But setups aren't guarantees. They're simply frameworks for thinking probabilistically. You cannot understand silver without understanding gold. The two metals move in a dance that's lasted centuries. Sometimes they move in lockstep. Sometimes silver leads. Sometimes it lags dramatically. Right now, the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, sits in the 20s. Historically, this ratio has fluctuated wildly. It's been as low as 15 and as high as 120. When the ratio is high, silver is relatively cheap compared to gold, and when it's low, silver is relatively expensive. The current level suggests silver has been gaining strength relative to gold. This matters because gold often acts as the lead indicator for precious metals sentiment. Gold is the larger, more liquid, more institutionally accepted market. When gold moves, silver tends to follow with amplification. Gold's own position, near historical highs, provides context for silver's current move. If gold continues higher, silver historically tends to outperform in percentage terms. The volatility cuts both ways, but the leverage to gold's moves can be substantial. However, silver also has unique characteristics. Unlike gold, which is primarily a monetary metal, silver has significant industrial demand. More than half of annual silver consumption goes into industrial applications: electronics, solar panels, medical devices, automotive components. This dual nature creates complex dynamics. In inflation-driven precious metals bull markets, silver benefits from both monetary demand and industrial strength. In economic slowdowns, industrial demand can weaken even as monetary demand rises. The current environment shows strength in both areas. Industrial demand for silver remains robust, particularly in green energy applications. Monetary demand is rising as investors seek inflation hedges and currency alternatives. This combination, when it occurs, can create powerful bull markets in silver, but it also means silver faces dual risks. If economic growth slows sharply, industrial demand suffers. If monetary conditions suddenly tighten dramatically, monetary demand retreats. Understanding these relationships helps us avoid simplistic narratives. Silver isn't just rising because of one factor. It's rising because multiple supportive conditions are aligning simultaneously. Behind every price movement lies supply and demand. For silver, these fundamentals have been shifting in ways that support higher prices. On the supply side, silver faces unique challenges. Unlike gold, most silver doesn't come from primary silver mines. Approximately 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. This means silver supply doesn't respond quickly to silver prices. A mining company doesn't increase copper production just because silver prices rise. The economics of the primary metal drive production decisions. Primary silver mines do exist, but bringing new capacity online takes years. Exploration, permitting, construction. The timeline from discovery to production can exceed a decade in many jurisdictions. Meanwhile, above-ground inventories of silver available for investment or industrial use have been declining. Exchange inventories, particularly in major silver ETFs and on commodity exchanges, have drawn down substantially in recent years. This doesn't mean physical shortages are imminent. Silver markets remain functional with adequate supply for current demand. But tight inventories mean less buffer to absorb sudden demand spikes. On the demand side, several trends are converging. Industrial demand continues growing, driven primarily by solar panel production and electronics manufacturing. The push toward renewable energy requires vast amounts of silver. Each solar panel contains silver, and global solar installations are expanding rapidly. Investment demand is reawakening after years of dormancy. Precious metals ETFs are seeing inflows. Coin and bar sales are rising. Investors who ignored silver during the long bear market are reconsidering allocations. Then there's monetary demand from nations diversifying reserves. While gold dominates official sector purchases, silver plays a role in broader conversations about alternatives to dollar-based reserve systems. These demand sources operate on different timescales and respond to different drivers. Industrial demand is steadier but tied to economic growth. Investment demand is more volatile but can move rapidly when sentiment shifts. Monetary demand is slower but potentially more structural. The current environment shows strength across all three categories. This broad-based demand, combined with supply constraints, creates fundamental support for higher prices. Fundamentals don't determine short-term price movements. Markets can remain disconnected from fundamentals for extended periods, but over longer time horizons, supply and demand fundamentals typically reassert themselves. Silver, like all commodities priced in dollars, moves inversely with dollar strength. This relationship is crucial for understanding current price action. When the dollar weakens against other major currencies, commodities priced in dollars become cheaper for international buyers. Demand rises, prices follow. When the dollar strengthens, the reverse occurs. Commodities become more expensive in foreign currency terms. Demand softens, prices decline. The dollar's trajectory depends on Federal Reserve policy, relative growth rates between the U.S. and other economies, trade balances, and global risk sentiment. These factors shift constantly, creating volatility in currency markets that translates into commodity price movements. Recent dollar weakness has provided a tailwind for silver and other commodities. Whether this continues depends on factors beyond precious metals themselves. But there's a deeper currency dynamic at play, one that transcends quarterly dollar movements and speaks to longer-term monetary concerns. Global debt levels, measured as a percentage of GDP, remain near all-time highs. Government debt, corporate debt, household debt. The total debt burden across developed economies creates a situation where traditional deleveraging becomes economically and politically difficult. This debt overhang limits policy options. It creates structural pressure toward currency debasement as the path of least resistance. Not hyperinflation necessarily, but steady erosion of purchasing power over time. This is the environment in which precious metals have historically performed well, not necessarily crisis or collapse, but steady concern about currency stability and purchasing power preservation. Silver, as a tangible asset with thousands of years of monetary history, offers an alternative, not as a replacement for functional currency systems, but as a hedge against their gradual erosion. This narrative grows stronger as more investors question the long-term sustainability of current monetary arrangements. It doesn't require crisis to drive precious metals higher. It simply requires sustained concern about purchasing power. The composition of who's buying and selling matters enormously in markets. A price driven entirely by retail speculation behaves differently than one supported by institutional allocation. Silver's current move appears to involve both. Retail interest is rising, evidenced by coin sales and social media discussion. But institutional participation is also growing, shown through ETF flows and futures positioning. Institutional involvement typically provides more sustainable support. Institutions allocate based on portfolio theory and risk management frameworks. They size positions according to volatility and correlation. They think in quarters and years rather than days and weeks. Retail participation can provide explosive momentum. Retail investors, especially those newer to markets, often buy strength and sell weakness. They respond to headlines and short-term price movement. This creates feedback loops that amplify moves in both directions. The ideal scenario for sustained bull markets combines both. Institutional accumulation provides a floor and steady demand. Retail momentum provides the spikes and breakthrough moves that capture attention and create new price ranges. The risk comes when participation becomes overwhelmingly one-sided. If a move is driven purely by retail speculation without institutional support, it tends to be fragile. When momentum slows, there's no deeper base of support. Conversely, if only institutions are involved without retail participation, moves tend to be gradual and lack the explosive momentum that characterizes major bull markets. Watching the composition of participation helps assess market health. Are we seeing broad-based involvement across different investor types? Or is the move concentrated in one group that might reverse suddenly? For silver at $99, the evidence suggests mixed participation. This is generally constructive. It means different investor types with different time horizons and motivations are finding reasons to buy. But it also means we need to stay alert to shifts in this composition. A surge in pure speculation without fundamental support would be a warning sign. A complete absence of retail interest despite major price moves might suggest the move lacks the momentum to break through significantly higher. If you already hold silver, whether in physical form, ETFs, or mining shares, this moment requires clear thinking about your position. First, revisit why you bought. Was it insurance against currency debasement, speculation on price appreciation, portfolio diversification? The answer determines how you should think about current price levels. If you bought as insurance, as a long-term store of value, then $99 doesn't change your thesis. Insurance positions aren't meant to be traded around short-term price movements. They're meant to be held as ballast against specific risk scenarios. If those scenarios remain relevant to your situation, your position remains relevant regardless of price. You don't cancel homeowners insurance because the premium value fluctuated. If you bought for speculation, for price appreciation, then you need a framework for taking profits and managing risk. Speculation without discipline is gambling, and gambling without defined rules leads to predictable outcomes. Consider a scaling strategy. As prices rise into significant levels, reduce position sizes incrementally. Take some profits at psychological milestones. This accomplishes several things. It locks in gains, making your remaining position more comfortable to hold. It reduces overall portfolio risk as a single position grows large. It removes the pressure to make perfect timing decisions, since you're acting gradually rather than all at once. A simple framework. Reduce positions by 10 to 20% at each major milestone. Not because you think the top is in, but because you're managing risk and ensuring you benefit from the moves that have already occurred. The psychological benefit is enormous. Knowing you've already secured some gains makes it much easier to hold remaining positions through volatility. You've eliminated the scenario where you give back all profits due to indecision. Second, consider your total portfolio allocation. As silver rises, it likely represents a larger percentage of your overall wealth. Even if you haven't bought more, price appreciation changes your allocation. If silver has grown from 5% of your portfolio to 15% through price appreciation alone, you have a decision to make. Are you comfortable with that increased concentration? Does it still align with your risk tolerance? There's no universal answer. It depends on your age, income, other assets, goals, and psychological comfort with volatility. But the question must be asked consciously, rather than allowing allocation drift to occur passively. Third, prepare emotionally for volatility. Silver at $99, especially if it breaks 100, will attract attention and speculation. That attention creates volatility. Sharp moves up and down, sometimes within single trading sessions. Volatility isn't a problem if you're prepared for it. It's only a problem if it catches you off guard and triggers emotional decisions. Decide now, before volatility intensifies, what price movements would cause you to reconsider your position. Write down specific levels or portfolio allocation percentages that would trigger review. Having these predetermined frameworks removes emotion from real-time decision-making. Fourth, remember that you don't have to make permanent decisions. You can reduce positions to manage risk while maintaining exposure to further upside. You can take profits on a portion while holding a core position long-term. The binary thinking that you must be either all in or all out is false. Sophisticated investors think in probabilities and size positions accordingly. They scale in and out gradually as conditions and prices change. Finally, avoid the trap of trying to sell the top. Nobody can consistently identify exact turning points in advance. The goal isn't perfection. The goal is reasonable decisions that align with your situation and sleep comfortably at night. If silver reaches levels that make your position uncomfortably large, reduce it. If it reaches levels that fulfill your investment thesis, take profits. Don't let fear of missing additional gains prevent you from securing meaningful wins that have already occurred. If you don't currently hold silver, but are considering entering now, your decision framework is different. You're not managing existing gains. You're evaluating whether current prices offer acceptable risk-reward ratios. The first question is, why do you want exposure to silver? Be honest and specific. Is it fear of missing out on further gains? Genuine concern about currency or economic conditions? Portfolio diversification? Speculation on breakthrough momentum? Your motivation determines how you should approach entry and position sizing. If your motivation is primarily fear of missing out, that's a warning sign. FOMO is one of the most expensive emotions in investing. It leads to buying at peaks, overpaying for momentum, and entering right when those already positioned are looking for exits. This doesn't mean you shouldn't buy. It means you need discipline around how much and at what levels. If your motivation is hedging against macroeconomic concerns, then current prices need to be evaluated against those specific risks. Has anything about currency stability, debt levels, or monetary policy changed in the last month? Or are you reacting to price movement rather than fundamental assessment? Price movement itself can be informative. Markets aggregate information from millions of participants. Rising prices can signal changing conditions, but they can also signal speculation disconnected from fundamentals. The way to separate signal from noise is to evaluate your thesis independently of price action. If you believe macroeconomic conditions warrant precious metals allocation, then silver at $99 might be reasonable within a diversified approach. If you can't articulate why you want exposure beyond it's going up, you're probably not ready to buy. For those who do have genuine reasons for wanting exposure, position sizing becomes critical. How much capital are you willing to allocate? How much volatility can you emotionally tolerate? A common mistake is sizing positions for maximum gain rather than maximum tolerance. New investors often think, if silver doubles, I want to make a lot, so I'll put 20% of my portfolio in it. This backwards thinking leads to forced selling during inevitable volatility. Size positions for what you can comfortably hold through 50% drawdowns, not what will make you rich if you're right. A more disciplined approach, start with a small exploratory position, 1 to 3% of your portfolio. This gets you involved, allows you to learn how you react to volatility, and establishes a base without creating overwhelming risk. If prices decline from here, you have capital available to add at better levels. If prices rise, you have exposure and can decide whether to add to a winning position or simply let it run. Regarding timing, $99 represents a difficult entry point psychologically. You're buying at new highs, right before a major psychological level. This feels uncomfortable, and that discomfort is valuable information. The discomfort doesn't mean don't buy. It means proceed with awareness and discipline. Use limit orders rather than market orders. Scale in over time rather than all at once. Have predetermined levels where you'll add more or cut losses. One approach. Divide your intended allocation into 3 or 4 tranches. Buy one portion now, buy another if prices pull back by a specific percentage, buy another if prices break through 100 and hold for a sustained period. This removes the pressure of making one perfect decision. You're acknowledging uncertainty and positioning accordingly. For those interested in silver exposure, consider the vehicle carefully. Physical silver offers tangible ownership, but involves storage and liquidity challenges. ETFs offer easy access and liquidity, but lack physical possession. Mining stocks offer leverage and dividend potential, but add company-specific risk. Each vehicle serves different purposes and involves different trade-offs. Many sophisticated investors use a combination: core physical holdings for long-term security, ETF positions for tactical trading, mining stocks for leveraged exposure. Whatever vehicle you choose, understand its characteristics completely before committing capital. Read the prospectus for ETFs, understand storage costs for physical, research balance sheets and management for mining companies. Finally, remember that you're late to this move. Silver hasn't just started rising. It's been advancing for months and is now approaching a major psychological level. That doesn't mean you can't profit from here. But it does mean you shouldn't expect the easy gains of those who bought much lower. Late entry requires even more discipline. Smaller position sizes, tighter risk management, clearer exit strategies. You don't have the cushion of large unrealized gains to ride out volatility. Whether you currently hold silver or are considering entry, certain mistakes recur with predictable regularity during volatile market periods. Avoiding these errors is as important as any positive action you take. First, emotional trading, making buy or sell decisions based on fear or greed rather than predetermined strategy. This is the single most destructive behavior in investing. It turns rational frameworks into reactive gambling. Silver at $99 will generate strong emotions. If it breaks 100, excitement and fear of missing out will intensify. If it fails and reverses sharply, panic will emerge. These emotions are natural. Acting on them impulsively is optional. The antidote is predetermined frameworks. Decide before emotions spike what actions you'll take at what levels. Write these down. When the moment arrives and adrenaline clouds judgment, you have rational instructions from your calmer past self. Second, over-leveraging. Using margin, options, or other leverage to amplify exposure beyond your actual capital. Leverage multiplies gains, but it also multiplies losses and adds the risk of forced liquidation at the worst possible times. Markets can remain irrational longer than you can remain solvent when leveraged. A position that would be merely uncomfortable without leverage becomes catastrophic with it. Prices that would eventually recover force you out if you're leveraged. There's no upside scenario where leverage is worth the risk for investors seeking long-term wealth building. Speculation with leverage is fine if you understand you're gambling with money you can afford to lose completely, but don't confuse it with investing. Third, treating mining stocks like precious metals. Mining stocks offer leveraged exposure to metal prices, but they're equity investments with company-specific risks: management quality, balance sheet strength, operational execution, political risk in mining jurisdictions. A mining stock can decline even as silver rises if the company faces operational problems. Conversely, well-run miners can outperform during bull markets, but they require research and monitoring beyond simply having a view on silver. Don't buy mining stocks assuming they're equivalent to silver exposure with extra upside. They're separate investments requiring separate analysis. Fourth, ignoring tax implications. Profits are taxable events. Different vehicles have different tax treatments. Physical silver is often taxed as collectibles at higher rates than securities in some jurisdictions. Mining stocks generate capital gains or losses. ETFs have specific tax characteristics. Understand the tax implications of your actions before you take them. Consult with tax professionals regarding your specific situation. Tax tail shouldn't wag the investment dog, but surprises at tax time are avoidable. Fifth, checking prices constantly. Looking at silver prices multiple times per day creates psychological wear and increases the likelihood of emotional decisions. Volatility that's meaningless over weeks or months feels overwhelming when you're watching minute by minute. If your investment thesis is sound and your position size is appropriate, you shouldn't need constant monitoring. Check periodically, perhaps weekly for active positions or monthly for long-term holdings. More frequent checking suggests either poor position sizing or lack of conviction in your thesis. Sixth, listening to extreme voices. During volatile periods, the loudest voices tend to be the most extreme. Silver to $500, silver crashing to 20. These headline-grabbing predictions generate clicks and attention, but they rarely help you make better decisions. Extreme scenarios can happen, but building strategy around them is generally unproductive. Focus on probable outcomes and position accordingly, while maintaining some protection against tail risks. Seventh, confusing market participation with intelligence. When you're actively involved in a market, especially one that's moving dramatically, it's easy to feel knowledgeable and competent. You're following news, watching prices, making decisions. But activity isn't intelligence. You can be very busy and very wrong. Sometimes the intelligent decision is to do nothing, to wait, watch, and let situations develop before committing capital or making changes. Eighth, anchoring on purchase prices. If you bought silver at $60, that price is psychologically significant to you. But it's completely irrelevant to the market and to optimal decision-making. The market doesn't care what you paid. Only you care. Every day you hold a position, you're making a fresh decision to own it at current prices. Your purchase price is sunk cost. Base decisions on current conditions and forward probabilities, not on where you happen to enter. Ninth, seeking confirmation bias, looking only for information that supports your existing position. If you own silver, you'll naturally gravitate toward bullish analysis. If you're skeptical, you'll seek bearish views.